doesn't have a target, Laura, and you write the economic power of the model less certain today than at any time since going public, we believe. And you see a lot of their spending as reactive rather than proactive.
Yep, I do.
Can you expand on that? What exactly is wrong with the spending strategy at this point?
Okay, so we have two problems here. We have revenue slowing. Their first quarter guidance is for 3 to 11% revenue growth, which is 800 basis points below consensus estimates of 15% growth. We're now modeling 15% growth for the whole year of revenue. That's a big problem, this flowing revenue, coupled with the CEO came on the call and talked about 7 areas of investment. And essentially, they're trying to catch up to YouTube, TikTok, by expanding into types of content that have nothing to do with your friends. This is like an existential pivot from you just talking to your friends via text and you suddenly consuming like video, mostly video, but video and other types of content that have nothing to do with your friends. And other people got there first and they're sort of late to the party. And then Meta is a huge expense with no near-term return on capital. And then they went through seven different commerce. They're going to have to redo their privacy. They're investing in their ad tech stack. So there's 7 areas of spending at a time. So we took our margins down by 1,000 basis points to 30% for this year. And they have a slowdown in their revenue. So like the whole business model has been upended as of last night.
Yeah, I do wonder, Laura, I mean, obviously it's gotten cheaper. The balance sheet is very strong. They're buying back a ton of shares. The ad market at large is durable. And in the past, at least, they have shown creativity in managing to either outmaneuver their budding rivals or new technologies. Snap's a good example of that. Why do you think that won't happen now?
So I think the reason that Alphabet's, I think what's becoming clear to me is the reason that Apple and Alphabet's earnings were so strong is it has to do with Apple's privacy gates becoming more strict. And Google, as you know, pays Apple about $10 billion a year. So Google still has all of the targeting capability on Apple's devices, which is about 40% of U.S. users. And so there's this binary. If you're not in bed with Apple, your numbers are horrible. You're being negatively affected by these privacy changes. As you're part of the Apple ecosystem and a party to their first-party data and all the great data they have, like Alphabet is, you are singing in the rain. It's fantastic for you. So I think that's what's going on here. The binary outcome is that Facebook is on the outside of those Apple changes, and it's really hurting their ability to target and measure on iOS devices, whereas Alphabet pays Apple a lot of money every year to get access to all of their data, and not just now. It's been for a decade.
Laura, I don't think that Google Alphabet is in bed with Apple or getting access to that data. I think that was a nice line that Facebook gave out in the earnings call to sort of point over there and say, hey, well, there's a business relationship. That's why they're not affected. But Google, people are logging in at certain places and showing their intent through search. Google, through search and YouTube and other things, doesn't have to follow people around the web quite the way Facebook's ecosystem is set up. But all of that being said, there are only so many places where you can go for digital targeted advertising. Facebook has a ton of inventory, a lot of different cohorts they can sell. At what point is this sell-off overdone? Because, yes, even if it is $10 billion worth of revenue impact for the full year, though something tells me Facebook was sandbagging there, there's still plenty more revenue to go around, right?
No.
No?
I think the business model here is broken. Revenue declines coupled with very large cost advances. If this was a CEO that was a professional CEO, which is, Mark Zuckerberg can't be fired, in my opinion, he would be. With these kinds of pressures on your revenue line, he should be saving money. He should not be spending on metaverse, which is 10 years away. You can't fire him, so that's why he'll hold on to his job. But these results are really abysmal.